Every financial crisis produces the same advice for the middle class. Pay down your debt, hoard cash, cut your expenses, stay liquid. Don't make any big moves, play it safe and wait for the storm to pass. This advice is everywhere. It comes from financial television, from personal finance blogs, from well-meaning neighbors, from the same institutional media that is owned by the entities that will spend the next 18 months doing the exact opposite. Here is what the billionaires are actually doing while you are cutting your expenses and hoarding cash. They are hunting, not metaphorically, systematically, with prepositioned capital, pre-identified targets, and a playbook that has been refined across every major financial dislocation of the last century. While the middle class is playing defense, protecting what it has, avoiding risk, waiting for certainty that never arrives, the people who understand how crises actually function are deploying capital at a speed and scale that permanently alters the distribution of productive assets in the economy. Crises are not natural disasters to be weathered. They are scheduled shopping events for the people who prepared for them. If you play defense, you don't sit out the game, you become the inventory, the pivot. Financial historians tell you to look at Weimar Germany and learn humility. Lower your debt. Trust your community. Store what you need. The lessons of hyperinflation and depression are framed as lessons in modesty, in the danger of ambition during unstable times. This framing serves a specific interest, and that interest is not yours. The ultra-wealthy don't read history as a lesson in caution. They read it as an operational manual. They extract from every crisis the same data point, which assets transferred from whom to whom, at what price, and through what mechanism, and they position accordingly before the next cycle begins. The system wants the middle class paralyzed by fear during a crisis. A paralyzed middle class does not compete for the distressed assets that the crisis is generating. It does not show up at the foreclosure auction. It does not purchase distressed debt at 17 cents on the dollar. It does not make the all-cash offer on the business whose owner is desperate to exit. Fear-based financial advice directed at the middle class is not neutral. It is the mechanism that clears the field. Here is the playbook that runs while the field is clear. Weapon 1. Weaponized debt. The leverage secret. The single most expensive financial myth the middle class has been sold is that all debt is bad. Not all debt is identical. The difference between debt that destroys wealth and debt that transfers wealth in your favor is not the existence of the debt. It is the structure of the debt and the nature of the asset it is used to acquire. Here is the mechanism that the wealthy have understood for centuries, and that conventional financial advice deliberately obscures. When you take out a long-term fixed-rate loan to acquire a productive hard asset, real estate, agricultural land, physical infrastructure, you are locking your obligation in nominal terms. The loan says you owe $400,000. That number is fixed. It does not adjust for inflation. It does not increase when the currency is debased. Now introduce an inflationary environment, the kind of environment that follows the monetary expansion that governments and central banks use to manage economic crises. The purchasing power of the dollar declines. Prices rise. The nominal value of your hard asset rises with them because the asset is anchored to replacement cost and physical utility rather than to paper currency. But your debt obligation remains fixed at $400,000 in nominal terms. In real terms, in terms of actual purchasing power, your debt is shrinking every year that inflation runs above your interest rate. You borrowed in valuable dollars. You are repaying in progressively less valuable ones. Meanwhile, the asset appreciates in nominal terms. Your equity expands from both directions simultaneously, from the asset's nominal appreciation and from the real erosion of the fixed liability against it. This is not speculation. This is the documented mechanism through which industrial fortunes were built in every major inflationary period of the 20th century. Weimar Germany's industrialists borrowed heavily in marks to acquire manufacturing capacity. They repaid those loans in marks worth a fraction of what they borrowed. They emerged from the hyperinflation owning real capital, free and clear, while the creditors who had lent the marks received back currency that purchased almost nothing. The advice to avoid debt during a crisis is advice that protects you from consumer debt, from borrowing to consume. It is catastrophically wrong when applied to debt structured to acquire productive assets in an inflationary environment. The elites know the difference. They have always known the difference. Weapon 2, the liquidity. Ambush, not cash hoarding. The middle class hoards cash during a crisis out of fear. This feels safe. It feels responsible. It feels like the adult decision in an uncertain environment. Here is what is actually happening to that cash while you hold it. In an inflationary environment, which follows every major monetary expansion, which follows every major crisis response, the purchasing power of cash declines consistently and measurably. The dollars you hoarded at the beginning of the crisis buy progressively less with each passing month. Your nominal balance is unchanged. Your real wealth is eroding. You protected the number. You lost the substance. The ultra-wealthy do not hoard cash in savings accounts. They hold short-duration sovereign instruments, treasury bills, 90-day government paper, that preserve liquidity while earning a return that at least partially offsets inflation. More importantly, they hold this liquidity not as a destination but as ammunition. They are not saving. They are loading. The distinction is the difference between a defensive posture and an offensive one. The cash-hoarding middle-class family is waiting for safety to return. The institutional investor, holding T-bills, is waiting for the moment when distressed sellers appear in sufficient numbers that the liquidity advantage becomes overwhelming. That moment always arrives. In every crisis, the forced seller, the leveraged investor facing a margin call, the small business owner who cannot service their debt, the homeowner whose income has disappeared, creates a supply of assets priced for desperate exit rather than rational value. The buyer with liquidity at that moment does not negotiate from the same position as a buyer in a normal market. They are the only buyer in a market full of desperate sellers. The price reflects the seller's desperation, not the asset's value. Warren Buffett's Berkshire Hathaway held over $130 billion in T-bills and cash equivalents in mid-2023. The financial press called it missed opportunity. It was loaded ammunition. Every dollar of that position was available to deploy the moment distressed assets appeared at prices that reflected crisis rather than value. Hoarding cash is fear. Holding liquidity as ammunition is strategy. The physical location of the money may look identical. The intent is categorically different. Weapon 3. Choke point assets. Not just useful goods. The conventional crisis preparation advice tells you to acquire useful things. Food storage, tools, skills that barter well in a disrupted economy. This advice is not wrong for individual survival. It is thinking at the wrong scale. The ultra-wealthy do not prepare for crises by acquiring useful goods. They acquire the choke points that control access to useful goods. The distinction is fundamental. A choke point is not a useful asset. It is a structural position, a node in a system through which a disproportionate share of essential economic activity must flow. Whoever controls the choke point does not need to produce anything. They simply need to be positioned at the bottleneck. Energy infrastructure, the pipelines, the storage terminals, the distribution networks that move fuel from production to consumption. Every economic activity in a modern economy runs on energy. The entity that owns the infrastructure through which energy must flow does not depend on the price of oil. It depends on the volume of throughput. Volume that continues regardless of whether the economy is growing or contracting, because a contracting economy still requires energy to run. Water rights. In the American West, and in a growing number of global markets, the legal right to access water from rivers and aquifers is a transferable asset. Water is not optional. Agricultural production, industrial process, and human consumption all require it in quantities that cannot be substituted or eliminated. Ownership of water rights is ownership of a choke point so fundamental that no alternative exists. Commercial supply chains. The logistics infrastructure that moves goods from production to consumption, the warehousing, the cold storage, the last-mile distribution networks, represents choke points through which entire categories of consumer goods must pass. Ownership of that infrastructure creates structural leverage over every producer and consumer it connects. During a crisis, these assets do not become less valuable, they become more valuable, because the disruption that depresses conventional asset prices simultaneously demonstrates the non-negotiable nature of choke point access. The neighbor bartering with their stored food is operating at the individual level. The institution that owns the distribution network through which that food moved from farm to store is operating at the system level. The ultra-wealthy do not want to barter with their neighbors. They want to own the system their neighbors depend on. The next financial shock is not a future hypothesis. It is already being priced into institutional positioning. The T-bill accumulations are visible in SEC filings. The private farmland acquisitions are documented in county records. The distressed debt positions are building in the portfolios of funds, whose quarterly letters are read by the people who manage sovereign capital. The machinery is running. The question that every person watching this needs to answer right now, not after the next crisis announcement, not after the next market dislocation, not when the headlines make the danger impossible to ignore, is whether they are going to spend the next economic contraction playing defense. Because defense in a crisis does not mean safety. It means becoming the inventory that the apex predators of the financial system have been waiting to acquire. The survival trap is comfortable. It feels responsible. It feels like wisdom. It is the mechanism through which wealth transfers from the paralyzed to the positioned. Every single cycle, without exception, across every economic crisis in recorded history. The escape from the trap is not complex. It requires clarity about what crises actually are, what assets actually survive them, and what the difference between defensive cash hoarding and offensive liquidity positioning actually means in practice. That clarity is what this channel exists to provide. Subscribe to Wealth History Vision. Stay awake in a sleeping world.